Hello everyone, my name is Matthew Frailey. I'm the founder of BreakpointTrades.com. We've been bringing you advanced technical analysis, market commentary, trade ideas, and sophisticated market trading algorithm systems like you see here with our SPY and ES systems since 2003 for individual traders and professional institutions which I consult with on a weekly basis. Okay, so let's go ahead and get started here. This is my back end that I use to record my newsletters for the website. You can see what things look like here. And let's go ahead and get this started. Hello everyone, Matthew Frailey with BreakpointTrades.com. This is a comprehensive weekend newsletter for Sunday, November 20th, 2022. I hope everyone's had a nice weekend so far. It's Sunday evening, again on November 20th. So this newsletter, again, these weekend newsletters tend to be quite comprehensive. You can see we have 8 major sections. All right, usually these weekend newsletters take about 50 minutes or so. So it's not meant to be a quick, 10-minute YouTube video to catch your attention. We dive into the weeds and go over everything in depth. We cover the general markets, sectors, important market indicators, bonds, interest rates, yield curve, US dollar, currencies, commodities, precious metals, and trade ideas. Okay. Below the table of contents, I have some quick observations here. Again, if you're listening to the newsletter on YouTube or if you're listening to it on the standard web page, you can pause and read this. But again, remember, first off, long term, remember we're on a bear market still. This is a bear market rally. Okay, we called for a bear market back in December and early January. So we were well ahead of the game. And obviously, as you know, this is Thanksgiving week. So the market has a shortened holiday week due to Thanksgiving. It'll be closed on Thursday and then open a half day on Friday. As far as seasonality for Thanksgiving, Monday tends to be one of the weaker months historically, going back to the 1940s. Again, doesn't mean it's always the case. And usually your strength occurs that day before Thanksgiving, Wednesday, and then of course that half a day on Friday. So we'll see how things play out this week. Last week we had OPEX, so we had $2.1 trillion worth of market options, so that helped to pin the S&P to that area. By the way, the previous week, guys, had the largest inflow of market, basically public inflow from the public into the market. Pretty interesting. Okay. Short-term support is the 9 EMA on the S&P. As expected, it stalled at that 4,000-ish resistance area that I'd highlighted a week ago. Pulled back from there. I expected that to be first resistance and to pull back from there on the first attempt. We're still in this wave C, which may unfold higher. 200-day moving average. There's an open gap from August, things like that. For now, the bulls have the football. Okay. What I'm seeing short term, the S&P has a coil. I showed on a 60-minute time frame. So Monday, we're likely to see a gap up or down. I'm kind of hoping we get a gap up and start some sort of fifth wave. That's what we're looking at. That if we get a move up from here, it could be starting this fifth wave of this wave C. Again, I'll go in that below. Again, obviously big resistance above the 200-day moving average, and recent highs. December 1st, PCE will be a big market moving event. On the negative side, I am seeing some negative divergence on some indicators like the NYMO, NYAD, breadth indicators, and the XLP S&P ratio. Okay, this week, obviously keep an eye on bonds, yield curve, and of course the dollar. Now, last thing, we are going to do a price increase officially here, probably December 1st. Okay, we're going to raise the 6-month membership maybe $10 to $15 a month. But guys, remember, it's been over 11 years since we had a price increase. And another thing, you are getting extra value. So for one, we have the SMS service on the website, which about a couple hundred of you have been paying $10 a month for. Everyone's going to get that for free now. So that's going to come as a free add-on to everyone. You'll be able to get the SMS. Number 2, I'm going to be adding some additional things to the KISS section. We'll also, for the SPY and ES systems, are going to have their own trading community, and I do plan to add more systems next year. Okay, the reversion to mean systems have had one hell of a year, giving over 100 trades this year. So if you've been following the SPY and ES systems, you've been knocking it out of the park this year. Anyway, let's go ahead and move on. Item number 2 shows the index sector table, what transpired on Friday. Again, Friday was an update for the market and for the week. So for the week, the indexes closed down. The Dow closed down the least, almost flat. Remember, the Dow represents value stocks, and that's what the market has been shifting focus back to all year, is value instead of growth, like the Nasdaq area. Nasdaq was down the most. You can see 1.6%. S&P down about 0.7%. As far as the major market sectors, most of the 21 sectors here were down. The exceptions were consumer staples, healthcare, drugs, and utilities. Currencies, US dollar up about 0.5%. And the cryptocurrencies were generally up for the week. We'll keep an eye on that. And commodities, mostly, to the downside. The general index, CRB, was down 3.8%. Crude oil down almost 10%. That was a big drop. Crude oil does not look too pretty. Natural gas up 7%. Copper down 7%. So that was a big sell-off. The ags were mixed here. Some were up, some were down. And coffee continues to get absolutely pummeled. Look at this. Down almost 7%. Talk to your Starbucks, see if they'll give you a discount. Precious metals all to the downside, including the stocks, as you can see. And as far as bonds, TLT 20-year bonds up, and of course the 10-year was up and 30-year was down. Next, item number 3 shows the economic news calendar for this week. Had to refresh that. I had the last week's data. So not a lot of news on the docket here, as you can see, for this week. Again, given the shortened holiday week. We do have the FOMC minutes on Wednesday. And we still have a few earnings season, but we're mostly through earnings season now. All right, guys, let's go ahead and jump to the charts. So the first image here, we're going to move this a bit out of the way too. We don't need to see all that. This shows you the stats for Thanksgiving, and these are from a couple different sources. Again, a lot of them say the same thing. This one here, they have stats in this turquoise going back to 1950, and you can see Monday was generally down. Your up days are usually the day before, day after Thanksgiving, and then the in orange here is from 1990, and Monday is actually up. So again, stats, take it for a grain of salt. They can do anything you want. Monday can be historically weak, but it can also be up. And here's a couple other versions. This table here, the data goes to 2017. I think the one on the left here is more recent, was updated here just a couple weeks ago. But you can see here on this table, again, Monday usually kind of weak, but Tuesday, Wednesday, the rest of the week usually favors upside. Next, image number 5. Here's this chart contains a yearly chart of the 5 key major indexes, and as well as bonds and again, this chart contains a yearly chart of the major indexes, bonds, and commodities. So you can see at the top, the Dow is so far this year is now down only 7.1%. Again, that's older economy, high value stocks. That has held up the best, and I expect that to continue to be the case during the bear market. The S&P below down 16.8%, so off those lows. The Nasdaq area down still about 28.5%. IWM, that's the small caps, below that down 16.6%. DBC commodities below that is up 21%. And at the very bottom, TLT 20-year bonds still down 31.5%. And that has really negatively affected a lot of the RIAs who use bonds to hedge their stocks. The problem with these RIAs is they never get you out of anything. They just buy and hold, and they simply rebalance over time. They never officially sell any of their instruments. Next. Chart 6, here's the moving on to the major indexes. So here's the weekly view of the major indexes. Again, still in these same expanded patterns that we've been showing. At the top, the Dow, you can see it's actually popped out of this downtrend line from the January highs. That is a slight positive. The S&P below, the Nasdaq, all the other ends have still not broken their official weekly downtrend lines here. The Russell at the very bottom is actually testing it, but still a little ways to go for the S&P and the Nasdaq. On a further market rally, that's the next major target. Next. Chart 7, here's a monthly view of the major indexes. So far, we have 2 up months. We were down initially early October, and then we reversed that, closed up nicely for October, and we're up so far this month. So seasonality has been playing out. That's pretty much what seasonality, how it's been in the past, where early October is weak, and then it strengthens mid-October into November, and that's what we've seen. But these charts here, these monthly charts, show you back to the beginning of the previous bull market, which was March 2009. And, then we had that really strong 2-month sell-off in 2020 into March. And then we had the blow-off move in that basically ended that last bull market. That's typical of bull markets where you end in a blow-off move. You get a slope that's much stronger than the previous uptrends, like you see here. So the S&P basically found some support near its monthly Bollinger Band as expected, and the Nasdaq, which has been the weakest, you can see it got to its 38% fib, unlike the S&P never got to that area. Next, chart 8, this chart shows you a quarterly view of the index. So each candlestick represents 1 quarter. So you can see the start of the previous bull market, early 2009. Then we had the slope greatly increased, where we had the blow-off move in the 2020, 2021 move. You can see all the indexes essentially found support at their middle quarterly Bollinger Bands. The Dow perfectly rallied off there. Big up quarterly candle so far, up 17.5% for this quarter. S&P didn't quite tag it, but it got pretty close. Nasdaq tagged its, again, middle quarterly Bollinger Band, and same for the IWM small caps. So that was a logical area. You can see that middle Bollinger Band on these quarterlies has been an important long-term area, and for now we've bounced off of it. Next. Moving on to our proxy, which is the S&P 500. So here's a weekly view of the S&P. Again, you can see this expanded downtrend channel. We started the bear market in January. We've had a series of longer-term lower highs, lower lows. Okay, you can see the 200-week moving average here. Price initially found support at it, briefly dipped below it, and then regained it. Okay, that 200-week moving average is always an important area. It's heavily watched by a lot of technicians. Moving average ribbon got very wide there. You can see when the moving average ribbon gets too wide, you get reversion to mean rallies. And so far, that's what we've gotten. And it's starting to pinch up here a little bit. You can see this year we've had 2 major pinches, squeeze, and those resulted in tops and an eventual down move. Again, should the market proceed higher, that we have a downtrend line here and the 50-week moving average in red, which would be a likely target. Okay. Next, chart 10. Here's another weekly view. Shows you the same thing, just a cleaner, expanded triangle. You can see again we do have room to move to the upside here, around 4,100 if it wants to. Next, chart 11. Here's a daily view. So early last week I showed this chart. You could see how you had if you drew Fibonacci retracements from the January highs to the October lows and from the August highs to the October lows, you had a fib overlap right here. A 38% fib overlapping a 61.8 fib. Whenever you have fibs overlapping, that's a very significant area. And you can see I expected price to tag it and then pull back from that area, and that's what it's done. Now we'll see if we can push up through it. You have the 200-day moving average up here. There's also an open gap right around here, and of course then you have your you could draw a downtrend line from here as well, which I don't show here. Next, chart number 12. Here's another daily chart. So in October, we had 5 waves to the downside. Whenever you have 5 completed waves, guys, whether it's to the upside or the downside, you expect then a pretty decent counter trend rally. So we had clear 5 waves. There's no ambiguity here. You had MACD divergence, you had RSI divergence. And that's why we expected a pretty decent low here in October. My thing that I put out in October was that we'd likely have some sort of ABC rally, which I show in green here. I said we'd have an initial A wave move up, which we did, a higher low wave B, which we did, and we've been working on this wave C ever since. Now, on a bearish view, could wave C have completed last week? It could have, or it could just, it could work its way higher to these other levels first. So we'll see which happens this week. I think Monday could potentially start with maybe a gap. I'm hoping we get an upside move, quite honestly. You also have an open gap from here from September where you had this wave 2 high, and you have a big open gap here. These open gaps like to get filled on the S&P, so that would be a likely magnet if we get another upside move here. Plus you have the 200-day moving average right around there in green. Next, chart number 13. Here's a 2-hour view. Again, we've been short term, we've been uptrending here since the October lows. We have higher highs, higher lows. We have a clear uptrend channel here. We have a demand zone, that's a support zone, which we rallied off of last week. You can see the open gap here, which I talked about on the daily, which started on that after the September high there, lower high. So that could be a good magnet to the upside. So if we get a move up, guys, I'm at least targeting filling this upside gap. Next, chart number 14. Here's the 60-minute view. Again, quite simply, we're coiling here. That's what we've been spending last week doing, coiling. So this is likely to resolve up or down. If we were to gap up on Monday, a strong gap, and it were to hold in the morning, that could be a breakaway gap, and officially start us on some sort of move up here in that wave 5 as I just discussed. Next, chart number 15. Here's another 60-minute chart with some fibs. This area was also a fib extension. We bounced off the 38% fib here for now. And again, for now, this is an important support right here. Next, chart number 16. Here's a 30-minute view. So we had a little completed wave here. What we're watching for is this pullback being a wave C, and then we're going to an ABC, and then we're going to is a wave 4, and then we get another move up as a wave 5. Hopefully we get that. Again, on an upside move, I'd be targeting that open gap from September. Next, chart number 17 is a 30-minute view. Again, showing you this potential wave count broken down. Again, if you don't understand this, that's fine. I'm just showing you what we've been watching. So the thing we're at least kind of favoring right now is we had a little wave 3 top here. The pullback last week is a wave 4, and then we would go up again in a wave 5. All right. Obviously, you need to hold this 3,900 area. Next, moving on to the KISS systems. Chart number 18. Here's the daily KISS trend system. Again, they've done their job this year. They've been mostly in cash. They got out. These KISS trend systems got out in early January. They took a long there in March, then got out. They took a long in July and got out in early August there. Actually made a little money there. And they recently went long about a month ago. You could see on the S&P. Right now we have 2 higher low DVTs. So The trailing stop essentially is at 37.50 on the S&P. Still pretty wide with respect to the to price here. So I would love to get another DVT higher here just to shore that up a bit. Next, chart 19. Here's the four charts here. Show you the different time frames we like to follow with some of these indicators. We have the daily on the upper left. We have a half day here on the upper right. So on these lower time frames, the ATR is now support. Okay, we do have a resistance cycle on the half day where price has been stalling. We do have a buy cycle on a 130-minute chart. On the 60-minute, we have an ATR resistance here. Next, chart 20. Here's VYM. And this is one that I'm going to be adding to the website for the KISS system. I think in this type of market, it makes a lot of sense. So this is the Vanguard high value dividend play. And it is actually positive for the year, guys, with its dividend. Think about that. It's positive for the year. It's up for the year. Again, that's what the market's focused on instead of growth. It's focused on value and dividend. And this stock is up for the year. So here's how it would have done so far with the KISS trend system. Would have went long there in March, would have went long once here in August, and it's been long here since mid-October. And you have 3, 4, 5 higher low DVTs now. Next, image number 21. So what this shows you is kind of like an example of a modern diversified portfolio from an investment advisor. You know, if you go to your standard investment advisor around your town, you know, the A.G. Edwards, whatever, even the independents, they'll take your money based on your age and risk tolerance. They'll divvy it up into 8 or 10 different asset classes, equities, fixed income, such as large cap, technology, mid cap, value, emerging markets, commodities, you know, various bonds, etc. What I'm going to be doing for the website is I'm going to add a section where I have these ETFs and I'm going to have the KISS charts for that. Okay, so that's another thing that you're going to get with the price increase of Breakpoint trades. So instead of just having the S&P and Qs, we're going to have sort of like a portfolio here. Next, got to zoom out on this image. So unfortunately, over YouTube, this image doesn't work too well. It's pretty big, but this here shows you the these ETFs that I'm going to be using for the KISS type system. So we have SPY, we have mid cap, we have triple Qs, we have the VYM, which is that dividend, high dividend growth, VT, it's another Vanguard, emerging markets, commodities, US dollar, we have TLT bonds, high yield corporate, etc. So that's the list I'm thinking of that I'll be including. Next, resize this. Image number 23. This shows you the going on to the triple Qs. Here's the weekly view again, and this expanding downtrend channel. Still got a ways to go to get to that downtrend line. Again, the Qs have done the worst this year because that's the older economy. That's the high growth area, which has gotten pulverized. Next, chapter 24. Here's the monthly view again. Essentially came down to the 38% fib retrace from the 2020 lows. So it was logical to find support there, which it did in October. And so far we got a slight up candle this month right now, up about 2.5%. Again, I still view a rally from here as a long-term bear market. What I don't see the market doing is just you know, going back to new highs from here. You know, at best I see some sort of lower high and then eventual down again. Next, chapter 25. Here's a Renko chart for the Qs. These can be useful just for seeing support and resistance on a clean value. Ultimately, it did bounce off this area. There was an air pocket here, but it didn't sell off into here. So we've rallied up into here. Next, chapter 26. Here's the daily chart. Last week we stalled at the 50% fib from the August highs, pulled back a little bit. We're still holding the 9 EMA. Again, your bigger targets on a rally up would be the downtrend line here from the January highs and the 200-day moving average. Next, chapter 27, here's a 2-hour view. We have a potential higher low here. One could use as a stop if you're long. Next, chapter 28, here's the daily KISS trends chart. Again, the only changes on this is the Qs went long last week with a new DVT down here at 265.20. The moving average did flip to a bullish configuration and is now pinching here. So hopefully we get a chance for another rally here so we can get this DVT up a little bit. It's still pretty wide there. Remember, in bear markets, these KISS systems usually don't do as well. Sometimes they can make some money like they did here in August, July, August, and other times they can be kind of a wash or a whipsaw. What has done the best this year is the reversion to mean systems because of the volatility, though they've been quiet here for the last 2 weeks. Next, chart 29, here's the 4 time frames. The daily up here, we had a resistance cycle where price has been pausing, as on the half day as well. You have the ATR there and the 130 minute, which is now support. Next, chart 30, this chart shows you some of the major sectors. Again, I'm not going to go over all the sectors here. I'm going to just cover a few of the basics. Chart 31, here's the transports, weekly view. You can see similar view to the major indexes and these expanded triangle patterns, wedge patterns, and so far we're still below the downtrend line here. Next, chart 32, XLF financials. Now, this one's done pretty well. Had a nice divergent low here. You can see divergence on the MACD. I don't have it drawn in there, but you can clearly see it. You could also see the 200-week moving average where price rallied off of, and it broke over its channel. So that's more positive. Next, chart 33, here's the daily view. Again, you can see this channel break we had back here in October, which we pointed out. Heck of a run above its 200-day moving average. And short term here, it looks like you have potential flag pattern. I would favor an upside break on this. Next, chart 34, healthcare. This sector has also done very well. You can see it's really not down much this year. It's hardly down now. And you got a breakout resistance right here at 135. Support is the 9, EMA, and 20 moving average. Next, chart 35, XLE Energy. This sector has done fantastic this year, as you know. Back in early January, I called for energy area oil stocks to be a leader, and that's what they've done this year. Got a little overbought here, pulling back. Crude oil has been weak, so we'll see if this ultimately loses the 20 moving average or not. If it loses the 20-day moving average, then this may be due for some consolidation. But overall, these stocks have done fantastic this year. Why? Because they have good earnings and P ratios. You know, that's what folks are focused on now instead of growth. Next, let's move on to some indicators. Chart 36, here's the VIX. So the VIX was down on Friday as you expected the market up, but one thing I'm seeing here is the VIX is now starting to get uncorrelated to the S&P. So this is the correlation indicator. Whenever you get these uncorrelation spikes, these can occur near trade lows or trade highs. You really don't know. Like this one here occurred near a trade low. You know, this one, you know, we continued down. This one here occurred and you had a rally for 4 days before forming a lower high. So whenever this starts to uncorrelate, sometimes the market, you know, is usually near some sort of inflection. Next, chart 37. This chart shows you the NASDAQ breadth with the 52-week highs minus the 52-week lows here at the top. And this has been one fantastic chart. Quite honestly, this is all I should have done this year. Back early in the year, in fact, in December, I talked about this. I said whenever this got near zero, we're in a bear market, would give you objective short opportunities. And that's what it's happened. It's given you 13 trade signals this year. Take a look at this. Whenever this difference, 52-week highs minus 52-week lows, got near zero. These were all near inflection highs. If you took a short every time this occurred, you got nice trades on it every single time. Again, here, this trade would have only lasted, 4 days, but it still worked out. This was a bigger short here. This was a bigger short here. Um, here you even had a short last week right here on Monday show up, and that was another good short, at least for a few days. So this will still be a chart to watch going forward overall in the bull market or in the bear market. Next. Chapter 38, here's the NYMO S&P McClellan oscillator. So this chart's also been pretty good this year whenever you had a divergence, positive divergence, which I show in blue here, where the S&P made a lower low, but the indicator formed a higher low. That is giving you good trade bottoms this year. On the flip side, though, it's also giving you some pretty good trade tops, such as back here in August, whenever this made a lower high, the NYMO. S&P made a higher high. Same here in March. And right now, you do have a higher low here and a higher high in the S&P. Now, we did get a pullback there. Is that enough or not? But, you do have a divergence showing up there. Next. Chapter 39, here's the Nyse indicator. This is another nice little indicator to watch. So far, it's still positive. The 2 and 5 exponential moving averages, they still have not crossed. You could watch for them to cross to the downside eventually. They're still fine. Next. Chapter 30, here's the NYAD. So NYSE advanced decline. And I think this is based on a 10-day moving average. Here you also have a divergence showing up. Okay. Negative divergence, just like last time in August you had one. So little short-term warning there. Again, that could be negated, but it is there. One more that I'm seeing is chart number 41. Here's the S&P at the top versus the XLP S&P ratio. And usually these move together, but we're seeing a divergence here on this. So those are a few that do give me a little pause, but we are coming into the Thanksgiving week, so we'll see if they play out or not. Next, chapter 42, high yield corporate bonds. Really not much to say here. We continue to chop out higher lows over time here. Still not much to say on it. Next, chapter 43, TLT 20-year bonds. Again, they had a clean trend line breakout long back here. Next. Chapter 44, here's a TLT, a monthly view. So this is one of our longer term targets. Doesn't mean we get here, but should bonds come down to the lows again, when the bear market does reassert itself, this could be an eventual target. Clearly, bonds have gotten absolutely destroyed here the last 2 years. Next. Chapter 45, here's the 10-year Treasury Yield. Again, it's at an ABC pullback here. It's basically inverse to TLT. Remember, as bonds move up, rates move down. Now, the bullish view here, guys, this is simply an ABC pullback, and it's gonna rally to a new high again. If that occurs, the market would not like it, but that is something to monitor. This area here is big support right around this 3480 area. Next. Chapter 46, here's the yield curve. This has been all in the news lately. Again, the yield curve went negative back in March, April of this year, as we pointed out. And it's just stayed negative so far. Take a look at this. And in fact, last week it fell again. Fell almost 33%. So it's back to levels not since the 1980s. Again, guys, a recession is coming. No doubt about it. Next. Chapter 47, moving on to currencies. Here's the US dollar. US dollar was up 0.6% for the week. But the dollar's had a nice sell-off for the last month, and that's helped the market rally. Again, this is an example of symmetry, guys. Symmetry played out. So remember, with symmetry, you note the point pullback on your pullbacks in your trend. You had a largest pullback right here, $5.40. That told you with high odds it would form a lower high, which it did here. A little doji last week. Next, chart 48, here's the daily view. Again, you can see also in the daily, we broke this channel, back tested it. So we didn't quite make it to the 200-day moving average, but kind of wondering what the dollar is going to do here. If it's going to, do we have a decent low here, or does it still need to work lower? That's going to affect the general market, obviously. Next, chart 49, Japanese yen, FXY, the ETF. Had a huge rally the previous week. Again, we had positive divergence developing here. Really looked like it wanted to rally, and congrats if anyone took that. That was a nice rally. Next, chart 50, here's the monthly view of the Japanese yen. Again, it basically went all the way back to the 1998 lows there, the Asian crisis, undercut it a little bit, but so far has rallied off that support area. But it has been absolutely destroyed. They have hammered their currency, especially since 2012. Look at that. Next, chart 51, here's the daily view. As I pointed out a couple weeks ago, had a tight coil here. Obviously popped up nice to the upside from that. Next, chart 52, here's emerging markets, EM. Emerging markets, it benefits when the dollar pulls back, and it definitely has benefited over the last month. Now, guys, this chart to me is longer term bullish, actually. So this began downtrending in February 2021. So the bear market in emerging markets started about a year before it did on the S&P cash. So it's been downtrending for, not quite 2 years, but almost. We have a bullish break in symmetry here. What I mean by that, this rally off the lows is the largest rally in the whole downtrend. So when that happens, you then look for a higher low. So ultimately, I'm expecting a higher low on emerging markets. Next, chart 53, there's the daily chart. Again, ultimately, I am expecting a higher low on this. Next, moving to cryptocurrencies, chart 54, Bitcoin. Again, Bitcoin 2 weeks ago broke this support. Since then, it's been just chopping around sideways. Ultimately, this chart is not pretty, guys. At best, I could see it maybe rallying up and testing this broken trend line. But ultimately, I think it works lower. And when it does, that may be a negative on the general market. You all know what happened, of course, with the FTX. A lot of money evaporated there. Next, chart 55, here's the weekly view of Bitcoin. Early this year, we put a target of 10,000 to 12,000 in Bitcoin. That represents this big support area, also by volume by price. And I've been starting to see other technicians starting to talk about this area. We haven't quite made it to there yet, but not too far away. It wouldn't take much to get down to that area. Next, chart 56, Ethereum also looks weak here. You can see broke this pattern last week, breaking to the downside here a little bit. Again, this is another area that concerns me about the market is the crypto. Next, let's move on to commodities, chart 57, DBC, weekly view down 3.8%. Next, chart 58, here's the daily view. We were showing this little wedge pattern the previous week. We broke that to the downside. Next, chart 59, crude oil down almost 10% for the week. You could see the moving average ribbon here. It flipped to the bearish side back here in July, and we had a bearish squeeze going on the previous week. Crude oil does not look good here. Next, chart 60, here's the daily view. We broke this triangle to the downside. Again, why is crude oil breaking down? Well, one thing, seasonality. Crude oil tends to be weaker this time of year, but also, guys, if we're facing a recession, maybe a worldwide recession, there's going to be less demand. Next, chart 61, copper. So copper had a heck of a breakout from this coil pattern, went almost to the 200-day moving average and has pulled back strongly. Now, the volume has been lighter here, but really I want to see if this can form a higher low in here. I still favor that, but let's see. Next, Chapter 62, coffee, weekly view down 11%. Coffee's been absolutely hammered here. Look at it. Early this year, made a new high, and it's been absolutely pulverized. Show this chart to your Starbucks barista, see if they'll give you a discount, but I bet they won't. But now it's at its 200-week moving average. Next, Chapter 63, here's the daily view. Now this is the tradable ETF Joe. We do have a potential little wedge here with some MACD divergence, little RSI divergence, ribbon super wide here. You know, this may be due for some sort of rally here sometime soon. Next, Chapter 64, sugar. So a couple weeks ago I talked about sugar. It was within this pattern, and it broke out nicely over the last 2 weeks. And you got a resistance up here. But you could have traded one of the ETFs and done well. Next, let's move to precious metals. Chapter 65, gold, daily view of gold. So gold, as you know, has been downtrending this year since March. It finally formed essentially like a triple bottom here in September into early November. It then finally broke the downtrend channel line, 50-day moving average, which was bullish. Got up near the 200-day moving average and is pulling back. For now, I view this as a bullish pullback. I do favor a higher low here, ultimately. Right now, this 1740 area is the support. Next, Chapter 66, here's GLD. That's the 60-minute view of the ETF. Late last week, we pointed out some MACD divergence, and that's played out the last couple days. Next, Chapter 67, there's a monthly view of gold. So far for this month, it's up about 7%. Trying to rally off this 50-week moving average, which I talked about. We had a double top earlier this year and a bearish MACD signal there. Again, we'll see what it does here ultimately. Also rallied around the 50% fib. Again, guys, if you wanted to be a super gold bug, one way to view this perhaps could, have this as a large ABC pullback. So this would be your wave 1, that'd be your wave A, your wave B, your wave C. But again, who knows? We'll see if, for that to play out, gold needs to just start rallying here strongly. Next, Chapter 68, silver. So far down for the week, 3%. It did rally off this demand zone, though, over the last couple months. Next, Chapter 69, there's the daily view of silver. Again, got up to this resistance zone, pulling back. I am watching for it to form a higher low within this area. Next, Chapter 70, GDX. So GDX, as you know, was downtrending this year. We identified a completed fifth wave pattern in September. We were correct on that count. It was very choppy. You essentially had an ABC correction, sideways move. Very choppy. It chopped a couple people up, including myself a little bit. But ultimately, it formed a higher low and rallied up either in a wave C, which could have completed, or we're in a 3. I still think I'm still favoring a higher low here and another eventual rally up. That's what I favor. Obviously, it's going to depend on what the market does. Next, Chapter 71, here's another zoomed out view of the daily. Shows you these wave counts. The completed fifth wave, A, B, C. We're now working on this C. You can see this 2850 area was logical to expect a pullback from there. You could see it was previous support in September, December of last year. And once broken support becomes resistance. Okay. I still favor some sort of higher low here. We're trying to bounce off the 90 EMA here. I could see a rally up right from here to take out this high, or it may be meaning an ABC correction where we bounce, form a lower high, come down again, and then go up. So one of these two I favor. Next, Chapter 72, I'm going to give you just a real-time example of symmetry. So remember, guys, symmetry is extremely useful for telling you when uptrends or downtrends have ended. So here's GDX, your downtrend began in April after this MACD divergence. You then measure the point value bounces through 86, was your largest rally in the downtrend, which began in April. But the rally off the September lows was $4.60. So quite a bit larger than this rally, a bullish symmetry break. So that told you with high certainty that this downtrend was over and to look for a higher low, which you got a couple of them and then rallied up. So symmetry played out. Next, chart 73. So this is right up on symmetry that I did a video up on. It talks about everything here. I'm not going to go on it, but again, you look at your uptrend or your downtrend. When you get a largest rally in your downtrend, you expect a higher low. Same for your uptrend. When you get a largest pullback in the uptrend, you then expect a lower high. Symmetry is very powerful. Systematic approach. Use it, guys. Next, chart 74. Here's GDX GLD ratio. So one positive here, and this is the chart I've been showing, is the ratio here. Your moving average ribbon had flipped to a bullish stacking here in late October, pinched and has rallied up. This is a good sign ultimately, the fact that this ratio is bullishly stacked now. Next, chart 75, GDXJ. Again, similar look to GDX. You can see it did stall at this resistance here, which was resistance back in August, and support in May. So this is a big area, but I still favor some sort of lower high in here and another rally up. Next, chart 76, SILJ. So those are my favorite ETFs, GDX, GDXJ, and SILJ if you don't want to deal with the individuals. This had a perfect rally near its 200-day moving average, which was the place to take some profits, and it's pulled back since. Next, looking at some individual names, chart 77, NG. We had this as a long idea, beautiful rally out of there to the 200-day moving average. Again, I do favor a higher low. Next, chart 78, AU. Another one that has done fantastic lately. Got it overbought here. It's pulled back on light volume, so I do like it. I want to watch to see if it can hold the 9 EMA here. Next, chart 79, GFI. Same deal. Huge rally up here on good volume. The ratio broke to the upside. And the pullback here has been on light volume, so I did buy a little bit here into the 9 EMA. Next, chart 80, DRD. Here's another gold stock. Beautiful coil here, which it broke out of. Pulled back here. I'm looking for a higher low. This is your bigger resistance. You got kind of a long-term base here that it could break out of. Finally, chart 81, Newmont, another one of the majors. It's been forming this base here. It initially broke down, but it's recovered this trend line, trying to find some support here. So there's some individual precious metal names, guys. Again, if you don't want to deal with those, just trade the ETFs, GDX, GDXJ, and SILJ. All right, now let's follow up with trade ideas. So chart 82, here's 9. This was a long idea by us and one of our subscribers over a month ago. Was one fantastic trade. It came out of a weekly long-term base. I call these Weinstein bases. Broke out over the 4 area and has had one hell of a move. I think this sucker could rally up to these areas over time, but I would not chase it long here. I would be looking to buy a pullback, higher low, because then I think over time it could rally again. So I'm looking for a pullback to establish another position on this one. Next, chart 83, here's the daily chart. Again, you can see this thing just literally went parabolic. Getting quite overbought here. Look how wide the ribbon is. So would love an eventual correction, maybe down to the 20-day moving average, where I'd be looking to start scaling back in. Next, chart 84, SCHD. Here's another chart I like, ETF I like long term. It's a dividend play, similar to the VYM. This one's also, I think it's up for the year now, technically. Next, chart 85, Crocs. I had this as a long idea about a month ago, and it's just been working up nicely ever since. It had a really nice base here. So I got to stop right here now at around this 90 area. I still hold some shares. Next, chart 86, Worldwide Wolverine. This is a long idea last week. It's one of these CCI bungee plays. It's basically like the systems. You get a CCI divergence where the CCI spikes below -250. This one went below -300. and diverge with price. You get your trigger off of a high of a doji. That occurred on Friday here. First target's the 9 EMA. Next target is the 9 EMA. Your stop goes at the lows. I like these type of plays because they're very mechanical. Next. Driver 87, AQN. This is another one. Now this did trigger technically on Friday, but again, it closed back below the trigger. Your stop should be right at that 741 low. Next. Driver 88, EBS. Here's a new one. So you got a tight trigger here, doji from Friday, CCI divergence. So your stop is technically 1 penny above Friday's highs at 12.55, and your stop would be at 12 or 11.76 right at the lows. Your buy stop is only good for Monday, guys. If it doesn't trigger on Monday, no trade. Next, Driver 88, ADM, one of Steve's longs from last week. It broke the little flag here. It's trying to hold out of here. As I said, if you're long here, maybe put a swing stop right here at the higher low. Next. Driver 90, AFMD, a long idea I put out a week ago. Resistance at 251. It never triggered there, but I'm watching it here, guys. Despite this pullback, I may look to take a lower risk entry down here instead of waiting for it to take out resistance up here. Okay. Next. Driver 91, Getty. Here's a low price stock. Had one hell of a move here. I also looking to take a little position down here intraday. Next, Driver 92, Boot Barn. Bullish pattern, broke out of a wedge, trying to form a higher low here. A swing stop could be right here at the 59.25 area. Next, Driver 93, CPNG. Kind of a cup and handle look. Long idea over this trend line. Next, Driver 94, DNOW, tight coil here. Next, Driver 95, UDR, long idea over this trend line, over this 40.95 area. I didn't see a lot of great long setups, guys, so that also has me a bit concerned. I had to really look to find just this small amount. So we'll see what happens Monday. Let me see where futures are this evening. Currently, ES futures are down about 4 points, so really not seeing much. Again, we'll see what happens on Monday because we have a coil. Watch to see which direction that coil sets up. Either a gap to the downside or maybe a breakaway gap up. Again, happy holidays, everyone, and hope you have a good Thanksgiving later this week. Take care.